Have you ever wondered how much office space can transform a community and extend a city's skyline? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Related Companies is making waves with its ambitious plans for a mixed-use development just south of downtown Austin. The company is set to triple its office space in a 6-acre assemblage that includes residential units, a hotel, and a plethora of retail and restaurant slots, even one fit for a grocery store. This development is poised to extend Austin's skyline across Lady Bird Lake, showcasing Related Companies' commitment to reshaping urban landscapes. Their vision is not just about creating more space, but about integrating diverse elements that cater to the growing demands of urban living. By increasing office space, Related Companies aims to attract businesses that want to be part of a vibrant, mixed-use community. This strategy aligns with broader trends in commercial real estate, where mixed-use developments are proving to be more sustainable and attractive to both businesses and residents alike. In comparison, if we look at the Kitchener-Waterloo region in Ontario, we see a similar trend. The area has been experiencing growth in mixed-use developments, combining residential, office, and retail spaces. This approach not only enhances the community's appeal, but also boosts the local economy by creating job opportunities and attracting investment. As cities on both sides of the border continue to evolve, these developments play a crucial role in shaping the future of urban living. Manhattan's retail leasing market is experiencing a notable resurgence. According to a recent report from JLL, the vacancy rates in Manhattan's prime retail corridors have reached their lowest level since 2017. This improvement marks a significant milestone as the availability of retail spaces in these key areas dropped to about 14% in the second quarter of 2025. This represents a decrease of just over a percentage point compared to the previous year. The report highlights an increase in asking rents for these prime retail corridors, which have reached a post-COVID record of $608 per square foot. This figure represents an 11% increase compared to the previous year, showcasing the growing demand for retail spaces in these areas. Notably, Soho and Times Square experienced significant rent increases, while Madison Avenue saw a decline. The prime retail areas in Manhattan include Times Square, Union Square, Herald Square, Fifth Avenue, Madison Avenue, Soho, and the Meatpacking District. Among these, Madison Avenue and Soho had the lowest availability rate, with only 9.6% and 10.6% of spaces available, respectively. Interestingly, Madison Avenue experienced a 14% decline in average asking rents, falling to $835 per square foot, while Soho saw a 19% increase to $351 per square foot. Significantly, Soho was the location for two of the quarter's largest lease signings. Los Angeles Apparel has secured a 24,700 square foot space at 480 Broadway, while members-only club Lightning Society signed a lease for 19,000 square feet at 427 Broadway. On the other hand, Herald Square had the highest vacancy rate, with 35% of spaces available. Despite this, it was also the site of one of the major retail leases this quarter, with Old Navy moving its flagship location to a 55,000 square foot space in Herald Towers, marking the quarter's largest retail lease by space. Times Square experienced the largest jump in average asking rents, with a 19.3% increase year over year, reaching $1,555 per square foot. However, about 21% of spaces remain vacant in this district. The ownership of several buildings in the area remains uncertain, as they are held by lenders, which may impact long-term leasing decisions by retailers. RAM Realty Advisors has expanded its footprint in the Southeast United States with a substantial investment in a grocery-anchored retail portfolio. The firm has acquired a 600,000 square foot portfolio consisting of 7 shopping centers, which are strategically anchored by top-performing grocers such as Whole Foods Market, Sprouts Farmers Market, The Fresh Market, and Harris Teeter. This $200 million investment was made through a combination of acquisitions and partnership contributions. This move aligns with RAM Realty Advisors' strategic focus on investing in essential retail in high-demand markets. Brian Maloney, who rejoined RAM as a principal last December after serving as vice president of real estate for Whole Foods Market, emphasized the attractiveness of grocery-anchored retail. He highlighted that this sector benefits from strong tenant demand and limited new supply, particularly in high barrier-to-entry submarkets with favorable demographics. The immediate trade areas of these shopping centers boast impressive demographics, with household incomes averaging $131,000. This demographic strength underpins the appeal and stability of grocery-anchored retail assets, which continue to draw investor interest due to their resilience and consistent demand. A New York real estate investor recently purchased a distressed office skyscraper on Wacker Drive in Chicago. They're now seeking a developer to transform part of the building into a hotel, adding 300 rooms. This initiative is part of a broader strategy to revitalize the property and adapt it to the changing demands of the market. This move highlights a growing trend in commercial real estate, where office spaces, especially those in prime urban locations, are being repurposed to accommodate different types of tenants and uses. The conversion of office buildings into hotels is becoming increasingly popular as cities grapple with office vacancies and seek to maximize the utility of existing structures. When we look at the Kitchener-Waterloo region in Ontario, we see a similar trend of adaptive reuse in commercial real estate. Here, older industrial buildings are being transformed into vibrant mixed-use spaces that combine residential, office, and retail components. This approach not only preserves the architectural heritage of the region, but also meets the evolving needs of the community. In the United States, cities like Chicago are also exploring similar adaptive reuse strategies. The hotel conversion plan for the Wacker Drive Tower is a prime example of how investors are looking to breathe new life into underutilized properties. By converting office space into hotel rooms, the new owner aims to attract visitors and boost the local economy, while also addressing the high office vacancy rates in downtown Chicago. In a significant development in the realm of retail real estate, Federal Realty Investment Trust has announced a pioneering agreement with Mercedes-Benz high-power charging. This partnership aims to install 500 electric vehicle charging stations across 50 of Federal Realty's retail centers nationwide. This initiative marks a substantial commitment to electric vehicle infrastructure within the retail sector and is seen as a forward-thinking move by industry experts. Federal Realty, based in Bethesda, Maryland, plans to roll out the first 20 sites next year, covering 8 states, including Arizona, Connecticut, and Florida. Among the identified properties are Camelback Colonnade in Phoenix, Lawrence Park Shopping Center in Broomall, Pennsylvania, and shops at Pembroke Gardens in Pembroke Pines, Florida. Each location is expected to feature up to 10 charging stalls that are compatible with any electric vehicle model. Don Wood, President and Chief Executive Officer of Federal Realty, emphasized the strategic importance of this partnership, stating that aligning with Mercedes-Benz enhances the customer experience and strengthens the long-term viability of their portfolio. This move is particularly timely, given the evolving landscape of electric vehicle adoption in the United States. According to the first quarter Automotive Market Trends report by Experian, there are currently 4.8 million electric vehicles operating in the United States, representing 1.6% of all vehicles on the road. Despite this, electric vehicle sales momentum has shown signs of slowing, with a recent Pew Research Center study indicating a decrease in consumer interest in purchasing electric vehicles compared to previous years. Moreover, Bloomberg has revised its forecast for electric vehicle sales in the United States, now predicting that electric vehicles will account for 27% of total passenger cars by 2030, down from an earlier projection of 48%. This adjustment is attributed to recent changes in federal policies, including the elimination of the $7,500 electric vehicle tax credit under the newly signed One Big Beautiful Bill Act. This collaborative effort between Federal Realty and Mercedes-Benz represents a significant step in expanding electric vehicle infrastructure and could serve as a model for other retail real estate investors looking to integrate sustainable practices and amenities into their properties. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.